Hey, what's up, investors? My name is Devin Moreno, and I'm an investor here in the Baltimore City, DC area. And one of the people from the channel, someone commented asking to show them how I use my spreadsheet. A lot of people see me use my spreadsheet to break down and analyze deals on this channel. I analyze a lot of deals on this channel and show you, hey, here's how I think of them. But this is just going to be an in-depth on the spreadsheet itself. So that way everyone can see it and everyone knows how to use it. So we're going to go ahead and talk about that at length. And also, throughout this video, I'm going to be showing you how I actually think of a lot of deals in this area. And I think this really should apply throughout the country. So how do I calculate my vacancy rates or my maintenance allocations, or how do I calculate my CapEx and all of that? All of that's going to be explained in this video. How do we get to the property taxes? How do we find these numbers? So I'm going to talk about that lightly as well. So let's go ahead and get into it. This is my calculator, and for any of you who have never seen this before, you're probably like, whoa, that is a lot of numbers. And so this is actually a lot simpler to use than it looks. You're going to see this is broken up into multiple tabs. So and I'm going to go over those tabs, and essentially you're going to see it's in multiple different sections. Here's how this works, okay? The BRRRR analysis, turnkey, house hack analysis, fix and flip analysis, and a subject to analysis. Note that each strategy is broken up into its own tab. You should not use the BRRRR analysis to analyze a flip. And what are these? The BRRRR is when you buy a property, you renovate the property, and you intend to take a loan out of the property, cash out refinance, to pull your money back out to pay yourself back for the loan. This is really important because you're going to have two sets of closing costs. You're going to have a secondary loan and a first loan, an initial loan that got you into the deal. Well, those two loans have different costs. They have to have different calculations. Turnkey and house hack analysis. This is when you're going to buy the deal, maybe you're going to renovate the deal, but then you have no intention of refinancing anytime soon, okay? So a lot of these are meant for like kind of a 5-year plan of a sort. And so with that, you often see that with turnkey properties where you just buy it and rent it, or house hack strategies where you buy it and live in it. So the next one is going to be fix and flip. This is where you buy the property, you're renovating it with the intent to sell it. So very specifically, the calculations on that are going to be all different. And obviously, subject to is when you buy the property, but you don't actually take out your own loan. Instead, you assume the existing loan, all right? The existing loan on the house instead. And then you have my construction tab. Now, this one's not available as of right now. Many of you have a different one than I have. This I'm actually creating after starting my construction company. So now, in the future, and if you buy the spreadsheet on my website, you'll get access to this at any time that it's created. I will send it to you in an email because I'll have a copy of your email when you purchase it. So basically, the number of units, all right, you notice here, it's kind of like a new calculation I have where you can tell how many beds, how many baths, and this will allow you to accurately calculate based on, these metrics that I'm adding in here, and I'm going to have a few more questions in here. This will calculate it all down here. What are your costs that you should expect based on your average cost of these things? And I allow you to flexibly modify that. And it'll go and break out all the way down here into a hard cost. And of course, they're all categorized out. So this would be a really great tool for anyone who has trouble calculating renovation costs. But it's not available yet. Like I said, just started my construction company. So I'm really kind of exercising my math here and seeing if my calculations come out correct. But today we're going to go ahead and just focus on purely the BRRRR strategy one. Note that they're all formatted exactly the same way. So how you use one is how you use them all, with the exception of the construction one, which I said is new. So let's go into it. Everything on this section here is what you actually want to fill out. The yellow, all right? Note in this legend, it says yellow. You can change this. White, don't change this. The white sections are just simply a calculation of what you inputted here in the yellow. So they will change as you change these numbers. It's not only to check your math, but also to see where you can do better, maybe to make the deal more positive. So then you have the final metric, which is this deal analysis. Is it a good deal? It doesn't actually tell you yes or no. It's just meant for you to decide if it's yes or no. And remember, those metrics are going to be different on every property. So you're factoring in taxes on flips versus this. It's more of your cash on cash return and also monthly cash flow in the building. So let's go into a mock-up display of how these interactions work. All right, so let's talk about purchase price. So this is the initial cost of the acquisition. That's this section here. We got purchase price for $205,000. This is, remember, a number that I just create, okay? 1,000, it doesn't matter. So 205, there you go. That's the cost of building. 20% down payment. So That's more normal to most investors. It might be a 10% down payment, whatnot, doesn't matter. This is just calculating the costs that you initially need to get into the deal. Then you have premiums paid for auctions, okay? So auctions often have a 10% premium, or at least that is very generally true in the auctions here in the Baltimore City area, the ones that I've experienced. So it will tack on 10% of this amount here and onto the cost, and that would be for the initial purchase. Then you have the renovation cost. Now, section is only that by itself and on every spreadsheet, okay? So even for the fix and flip, where renovations is also key, it's just one line. You're meant to analyze that somewhere else. So it's not meant for you to break that all down and all the costs here. So this is just to check if this is a good deal. So that's it. It's the only line you get for that. All right. Final ARV. Now, final ARV, I talk a lot on my channel how to find ARVs, but that is the value of the property after you're finished renovating it. So we expect this property to be $280,000. So next we have interest rates. This is, remember, the cash out refinance terms, okay? So this is after the second loan, not the first loan, not the 12% harder money cost. This is you've cashed out, refinanced it, and now you have a new loan that is taken over. So 7%, you're probably expecting more like 8% nowadays. Then you have years of the mortgage after the refinance. That's 30 years. We often expect 30-year fixed rates on our loans, but no worries there. And also, by the way, remember, this is all for residential properties, all right? I just have to make a quick segue on that because a lot of people might confuse like duplex, triplex, and quads as, commercial, or they might even think a duplex with like a beauty salon underneath of it is now a commercial property. It's not. Commercial and residential is referring to the zoning, okay? So a single family home, a duplex with a beauty salon under it, or a triplex and quad are all residential. They are not commercial deals. Even though you have a beauty salon in one of them, it is not a commercial deal. It is zoned as a residential mixed use, often property. Now, commercial deals are anything 5+ units, and then also maybe something solely devoted to commercial application, or like industrial or warehousing or whatnot. So if the entire building was a beauty store, then it is now commercial. It is a commercial loan. Okay, so that's just a bit of a difference here. All of these spreadsheets refer to residential only. Commercial loans totally change all of our metrics, especially on the loans and how you have to get out of them. So just note that this calculator can only be used for residential, but in the future, I am putting out a commercial one. So getting back into it, let's see some of these interactions, all right? So LTV for the cash out refinance, that LTV is a loan to value, all right? So that means we expect that out of this this value here, we expect to extract 85% of that when we do a cash out refinance. We're gonna get all of that back in the form of a loan that's gonna repay us back. How much is that? Well, you can see here, the after repair value is calculated again, but you'll see the final loan amount, mortgage, that's your new mortgage, right? After the BRRRR is complete, you'll see $238,000. So if this were 80%, now you're seeing new numbers, $224,000, all right? So it's changing the size of the loan depending on the percentage you're actually pulling out. 80%, 85% common on single family homes, 70-75 common on duplex, triplex, quads. So now we're looking at holding costs. Our holding costs is kind of over the life of the entire house. Okay, so often we do refer that as just like during the renovation period, but it's also during the life of the house itself. So we're factoring in vacancy. I say 5 to 10% average. Now, I do 5% on my rooming houses, mostly because they are almost never vacant. And it's just kind of the transitory nature of them, but also combined with the fact that they only really ever rent a room. But often I suggest more when you're dealing with either more low-income neighborhoods where sometimes you're going to lose a lot of money for just simply people not paying you rent, but also in the case of like single-family homes, the turnover process is a lot longer. Oftentimes, I just recommend for most newbie investors for conservative metrics, 10%. I go more depth into vacancy factor in other videos, but that's what I recommend. Just keep it at 10%. But if you notice what it does, let's say I change it to 5%, it takes your total expected revenue, all right, and then it does an allocation for that. So this is the amount of money you're making, but this is the amount you're actually going to make because you're expecting $960 of that to be removed every single year in allocation for whenever they inevitably move out and you have to turn over the unit. So you're making that money, but you're not really making that money. Anyone who ever thinks it's rent minus mortgage equals profit is doing this business all wrong. So tax assessed value, here we have what you would find on SDAT. That's the State Department of Taxes and Assessments, or Assessment and Taxes. Essentially, that's the Maryland website where you can find the value of the house. I go into that in my videos and how I find that. Property taxes, Baltimore is 2.248. Shocking, I know, we're actually higher than DC, higher than California. It's actually pretty absurd. So it's pretty much some of the highest in the nation for Baltimore City. So that is calculated here. And you'll see this takes that percentage of this value amount. That's the yearly, that's the monthly cost. So then we have property management fee. Oftentimes you're paying about 10%. You can get lower, you can get higher, you can get flat rates. I have a property management company where I manage other people's properties. I do $100 flat fees depending on how many units you give me. So like, you never know what you're going to really get. What I would say is 10% of the gross month's rent is the average. I would leave it at that, assuming you are not actively working with a property manager who has flexible deals like myself, or whatever. Maybe you're managing yourself. And if you're managing yourself, of course, put 0. But that's taking 10% of our monthly rent amounts and allocating them automatically to property management. And so long-term insurance, we often expect $1,200. So $1,200 is the average kind of here in this area for a normal single-family home. If you have anything more complicated or a larger structure, it's often I've seen it as high as $1,500 is generally where I've seen it go, especially if you're like house hacking and like higher end property. And are you in flood districts and whatnot? But so Maintenance, I often say $1,200 per unit. So here we're looking at a 2-unit property, and we see that here where I have 2 different units. All right, and I'll show you how we do that. But basically $1,200 per unit. So in this case, it would actually be 24. That's because you have multiple water heaters, multiple HVAC systems, multiple kitchens, multiple more bathrooms, whatnot. So your maintenance costs are expected to be higher. I say $100 per unit. Remember, these are all conservative metrics. So, and of course in my rooming houses, I do not do this. I keep it at $1,200 because it's all one family home underneath that umbrella. So if I ever manage a rooming house for yourself, for you watching this video, then you wouldn't do 24 or times 5 would be ridiculous to just occupying bedrooms. So utilities, we have $600. This is oftentimes, if you're paying the water bill, which is common in Baltimore City, I would analyze $600 per unit. So if you have a duplex, it's $100 per unit, in which case you calculate $1,200. Note that these are all the yearly numbers, all right? And the yearly numbers get replicated here, and then you can see the monthly calculation there. So then you have capital expenditures. Capital expenditures are things that will definitely break no matter what. So you have a roof, this is where your water heater and HVAC and all that. So the separation of multiple units comes into play of like tweaking those little things. But the capital expenditure is more for like a full replacement of those utilities. And so now we measure the cost of fully replacing the unit, divide that by the lifespan of the unit, and then, that's pretty much what your monthly allocation would be. You multiply that by 12 to get to your yearly. Look, long story short, if that was totally confusing, just put $600 per unit. That's perfectly fine. And so you're actually probably allocating more than you actually need to. And so depending, of course, the lifespan of it when you purchase the property, of course, you'd want to adjust that. But if you want to make it simple, $600, that's fine. Lead renewals, lead inspections in Baltimore City, you're going to have lead renewals depending on if you're lead safe or lead free. You're going to have lead inspections depending on if, the rental inspection, your rental inspections are for you actually renting the property legally. So if you don't want to do that, then I guess you can save costs on that. I would say about $150 per year just to allocate. Kind of depends. More so if you're lead safe and you have to keep continuously painting it. So leasing commissions are percentages. All right, now this is percentage of the rent amount over a 5-year time. Okay, so it's assuming that your unit is going to stay fully rented for 5 years and then turned over after 5 years. It's locked on 5 years. Why 5 years? That's kind of an average of someone might stay in a house. So essentially, we say you're going to give 100% of the first month's rent, and you're going to have to do that every 5 years. So leasing commission, you are calculating $320 or $27 a month for that. For that happens 5 years from now. And usually we leave this at 100% because that is typical. You're often giving 100% of your gross month's rent to lease out your property. Then you have condos, HOA fees, and whatnot. That's calculated here. Rent and income here per unit. So note in the spreadsheet what I recommend. It doesn't hurt it if you don't do this. Like if you put this to 0 because it's a single family, it's not going to change a lot. It's just one metric. It's like price per unit and stuff like that. What you'd actually want to do is delete it, and that'll actually change the number a little bit. So you notice it says debt per unit. Like that's one example here. When I put 0, it like changes it because it thinks it's a 2 unit that you're not making any money on. So actually delete it. And so that will actually calculate it appropriately. So this is where you go in, say all your units. If you need more, then just shift the cells down. It'll automatically calculate in for you. Remember, though, anything above a 5-unit property is not meant for this. So why add any more than 5? It's really for rooming houses. I count them as units, right? So estimated closing costs. Here we have your closing costs and are going to be going through twice, okay? So note this note here, all right? And it actually says it up here. It says, note, you will go through closing costs twice, all right? And that's because when you purchase it and when you refinance it, you have to do it again. So it actually calculates either a percentage of the sale. Remember, this is all for quick math, all right? So a percentage of the sale or just you estimating the number. What is it? $7,000. Do not use both. And so if you use both, it'll double calculate this whole thing. So you either have 0 and let's say, $7,000, or you have the reverse. Do not do one of those. So basically, you may have noticed that this thing calculates wildly. This is because it's actually calculating it based on the new percentage of the loan. So you'll notice that if we actually have this at 0 and this is 0, it's still showing a total closing cost of $20,000. Why is that? Well, that's because it's also calculating the auction premium and the initial purchase. So if we do 0 at this and 0 at this, you will then see that your total closing costs after all this, that's now at 0. So, but you will also notice, because of what I mentioned earlier, if I say 3%, it's calculating 3% of the initial purchase price and then 3% of the final ARV number. All right. So, or actually the final loan amount. Apologize. It's actually based on usually the loan amounts. So, well, except for transfer tax and such, which it does calculate. But it's a very loose calculation, this one. We actually have more detailed calculations in, like, let's say our fix and flip. So you'll notice our fix and flip, it actually breaks a lot of this down for you. And you'll notice sales costs. It's actually much more heavily weighted down. That's because it's more important to get these numbers right when we're talking about a fix and flip than if we're talking about the burst strategy. It's not so urgent. This is a rough calculation. Are we interested in the deal? Let's go. Most spreadsheets are never going to get exact, accurate down, and you probably don't want to in every case anyway because it's not very fast. So short-term financing. Now, next we have here interest rate. That's in the short term. How many points on the loan is going to be due for the loan. Amount financed. Now, note a lot of these, like points on the loan, for example, is not calculated for the final loan here. So sometimes you'll have points on this loan. So that's where maybe this number will come in more handy. It just kind of depends on what you want to do. But it assumes you are not getting any points on that loan. Maybe in future spreadsheets, I'll add that in. So amount financed, how much is actually being financed, holding time of the loan, all of this gets factored into your metrics. So let's go over these ones in the middle here. And basically ongoing expenses, these are now the expenses of property taxes and long-term insurance, you'll notice they're broken out into slightly a gap here. That's because we only wanted to calculate these. All right, these are calculating your mortgage, okay? So PMI, right? Or not PMI, PITI. So you don't really need to add that into this factor here. So this only includes these, all right? So that only includes these. Then we have the bank metrics. These are things that we're expecting. So total revenue figures minus the total vacancy allocation. All right, that leaves you income minus vacancy. That's the number right there. It did the math for you. Then your net operating income is your income minus your expenses. So now it's income, your gross effective income, minus your expenses that we calculated here. So that's what you're getting here. And then your profit. Now, the profit doesn't really rely on these metrics that we saw above. It actually is just simply a revenue minus mortgage. Here's how much you're making, in which case here, we're actually losing money. Let's make some money. So there you go. Triplex made some money on this one. So now you're seeing where it's okay. This is now what we expect yearly. This is what we expect monthly. Gross profit is that. Now, obviously, in this case, you're actually losing money because, as I mentioned, rent minus mortgage, you have to do all your allocations. So you're actually going to notice that you're still cash flowing negatively. Okay, so note that your gross profit and your cash flow are two totally different metrics. So basically, for the refinance metrics, we're going to be looking at, these are the rates. This is what the terms of the loans, kind of reminding you in a lot of cases, but it's also for the calculations, like that 30-year calculates into 360 months. So this is helping the calculations along. Then you have the initial purchase metrics. Down payment is now 0 because that's what we just put it at. The debt per unit, and then the debt servicing cost. Servicing cost would be your mortgage. So this is your debt service. That's your actual principal and interest only. All right, and then your mortgage payment. That is all of it. That's including now your property taxes and such, and then your short-term refinancing costs. And this is just a rental breakdown showing how much you're making from all the units and such. And then you finally get into, is it a good deal? And that is where we would show, okay, it's not. You're losing money every month. You have $28,000 left in the deal. So this is the amount of money you have in the deal after. So if it's a positive number, note, it reminds you of this. If that is a positive number, then that means that you actually made money. You actually made money. The loan exceeded the amount that you had to pay into it for renovations. Cash and cash return, it'll say this if you're actually not making money. So let's actually make this make money. So let's say one of your units is insane. All right, now you have positive numbers. You'll notice here it calculates your cash on cash return. Cap rate. Cap rate is totally irrelevant in this, but everyone wants to see it, so I put it in here. Cap rates are really only used for commercial properties. I don't care about them at all for other purposes. Debt service coverage ratio. This is how much above the mortgage amount, percentage-wise, are you making in rent. Most banks like to see 1.25 to 1.6. However, I know a lot of banks that only care to get 1, which means that your revenue must equal your mortgage, and then they're good to go, which is actually kind of crazy. But that's super important for my rooming houses and such, where they won't analyze it like that way. They'll always analyze it like, if we were to rent it out as a normal house, how much would it make? So regardless of how much you're actually making, they don't actually care about that. They care about, what does the appraiser say? So cash flow per unit, then that's just a metric for you if you want it, and that's it. So you'll notice the fix and flip, it'll have different metrics. So gross profit. Net profit is calculated after taxes. Okay, so it's calculating the taxes here. That's something you really care about, if you're flipping the home, and because it's only what you keep is that it's important. And income divided by months helped. So that's like if you quit your job, how much would you have made that month from that one property? You can see why 20,000 is my absolute minimum, because I'm just like, for gross profit, because I'm like, after that, it's like, dude, I don't even care about this anymore. So turnkey house hack analysis, you're often going to find that this one, you're going to have a lot more cash in the deal because you're not refinancing it. So your ROI and your returns are going to be lower. And this analyzes your returns based on gross profit metrics and cash flow profit metrics. Remember, gross profit is simply the minus in the expenses, but not minus in the allocations and such. So, or it's actually, I'm sorry, effective gross profit minus vacancy only. So how much you are expected to actually receive. But otherwise, all of this is going to be roughly the same. It's going to be the same almost every single time, all right? So that's pretty much my breakdown of that. If you are interested in the spreadsheet, you can go to devinmorenoinvesting.com. That's where I have it, and all of that's on there. Also, I will be putting out the new versions of spreadsheets. If you have already purchased the spreadsheet, I will give you the new one. Regardless, like if you've already purchased it, you get all the new ones forever for the life of this channel. So basically, let me know if you have any questions about these spreadsheets. Comment below if you're interested in one, and I will talk to you all very soon.